On Saturday, finance ministers from the Group of Seven (G7) wealthy nations secured a historic agreement setting a global minimum corporate tax rate, laying the groundwork for a global agreement. The agreement intends to put a stop to a 30-year race to the bottom on corporate tax rates, as described by U.S. Treasury Secretary Janet Yellen, in which governments compete to attract multinational corporations. What's the point of a global minimum? Multinational corporations are being discouraged from transferring earnings and tax payments to low-tax countries regardless of where their sales are made. Intangible income from drug patents, software, and intellectual property royalties is increasingly migrating to these jurisdictions, allowing firms to avoid paying higher taxes in their conventional home countries. The Biden administration expects that by proposing a minimum 15% tax rate, it will be able to reduce tax base erosion without putting American businesses at a financial disadvantage, permitting competitiveness on innovation, infrastructure, and other factors. Where are the talks being held? The G7 negotiations are part of a much larger, ongoing endeavor. For years, the Organization for Economic Cooperation and Development (OECD) has been coordinating tax negotiations among 140 nations on regulations for taxing cross-border digital services and preventing tax base erosion, including the implementation of a worldwide corporate minimum tax. By the middle of the year, the OECD and G20 countries want to have reached an agreement on both, but the talks on a worldwide corporate minimum are technically simpler and less contentious. It will be quite difficult for any low-tax country to try to sabotage an agreement if a broad consensus is formed. The minimum is likely to cover the majority of the $50 billion to $80 billion in additional tax that the OECD expects businesses would pay globally as a result of the agreement on both fronts. What would a global minimum tax look like in practice? Overseas profits would be subject to the global minimum tax rate. Governments could still establish whatever local corporate tax rate they wish, but if firms pay lower rates in one nation than in another, their home governments might top up their taxes to the minimum rate, removing the benefit of shifting earnings. Last month, the OECD reported that governments agreed on the general architecture of the minimum tax but not on the rate. Other issues to be worked out include whether investment funds and real estate investment trusts should be covered when the new rate will be implemented, and whether it would be compatible with U.S. tax laws geared at preventing erosion. What about the bare minimum? The focus of the discussions is on the United States' proposal for a minimum worldwide corporate tax rate of 15%, which is higher than the rate in Ireland but lower than the lowest G7 level. Low-tax countries and tax havens may suffer significant consequences if a final deal is reached. The injection of billions of dollars in investment from corporations has boosted the Irish economy. Dublin is unlikely to accept a higher minimum rate without a battle, having rejected EU attempts to harmonise its tax policies. The battle for low-tax countries, on the other hand, is more likely to be about gaining support for a minimum rate as close to 12.5% as possible or securing specific exclusions than it is about sabotaging the overall discussion.